Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
China hitting back against Trump's tariffs, but many are saying, Enda, that it's like measured, that they could have been a lot worse. It was still friendly the way they put it out. Having covered Asia and lived in Asia for so many years, what did you make of it?
I think it was immediate in its response. It was clearly thought out and they were ready to go with this. Alex, I was just looking at the list. There's the antitrust probe of Google, which isn't especially effective given the controls and limitations of Google there. There are tariffs on agricultural equipment like tractors and other vehicles. There's tariffs on energy imports, coal and LNG, for example. Export controls on tungsten and other critical minerals. And then some of those companies like Calvin Klein owner PVH Corp put on that entity list. So, it's a reasonable list in terms of just breadth of how they're responding to the US, but it's nowhere near the dollar for dollar kind of matching figure that you might have expected given the US has put 10% on all goods coming out of China. It is somewhat restrained. It's being interpreted as a signal, which is that, hey, look, we can retaliate further, but in the meantime, we're probably here to talk. And of course, we do know that coal is expected at some point between both leaders, Xi and Trump, over coming days. We'll have to see if that changes the story or not.
Yeah, that's kind of where I wanted to go, Enda, because we saw yesterday with Mexico, the leaders of Mexico and Canada, looks like a phone call can fix a lot of things. And these Chinese tariffs don't kick into February 10th. So does that give some potential for, again, as you mentioned, a phone call between Trump and Xi, maybe an opportunity to kind of take some of the stuff off the front burner?
On paper, you would say absolutely. Maybe both leaders are looking for an off-ramp, and maybe there will be negotiations. The new administration, in their executive orders that they put out, said one of the first things they want to do is sit down and have a look at what happened in the original trade deal between China, the so-called phase one trade deal between China and the US. That would all lend itself towards the new administration having an assessment to see where things are and then come back. But nonetheless, things have moved pretty fast. I mean, I'm not sure anyone expected an almost full-scale trade war against Mexico and Canada that we came close to yesterday. If anything, President Trump has been very consistent in terms of his hawkishness on China and on the trade deficit with China, and of course on fentanyl and all of the other issues as well. So there are plenty of analysts who are saying that of all of the news over the past week, the tariffs on China were probably not a surprise. Maybe the timing of them more, but not a surprise. They were to be expected, and it does signal intent on President Trump's side. Now, of course, as you say, early days, we'll have to see how those talks go. But right now, the US has put new tariffs on all goods coming out of China, and that's something that they hadn't done before.
What's the ask here? So clearly, with President Trump and Mexico and Canada, the ask was clear and had to do with fentanyl. What's the ask for China?
I mean, it's a whole different order of spectrum when it comes to the conversation, right? You're covering national security, you're covering IP protection, you're covering the merchandise goods deficit, the idea that the US doesn't think China buys enough stuff off of it. You've got the fentanyl issue. I mean, it's covering a whole range of issues here. And China's role on the global stage too, perhaps, in terms of its support for Russia, for example. But nonetheless, at least one thread on that is the merchandise goods deficit part of it. President Trump has highlighted that consistently. China in the past have signaled they are willing to buy more US produce. And of course, Davos hadn't officially made the point without naming the US. He said, they're also willing to step up in the global market and buy things. So there are ways where we'll say the merchandise goods deficit could be reached, could reach some kind of a midpoint on. But the national security, the technology, the export controls, the IP protection, fentanyl, the human rights issues, all of that's more complicated and probably maybe a different channel to the trade side of things.
And one could argue that the U.S. economy is in a stronger position than that of China. Therefore, the U.S. may have some leverage here. Is that a feeling that you're hearing, or is that a policy backdrop that you're seeing in Washington at all or hearing about?
I think it's certainly considered to be the backdrop. U.S. economy broadly doing okay. Obviously, there are areas of weakness, but consumers are still spending. That means the US remains the engine of global growth. We know the China story is still hampered by the real estate slowdown, but they're still pushing hard on innovation, as we saw with DeepSeek last week. So yes, there is a view that the US has the upper hand, but also practically, because if you're talking about getting into an argument over merchandise goods and I'll put tariffs on yours and you put tariffs on mine, well, China can't match that dollar for dollar, because they don't buy the same amount of stuff off the US that the US buys out of China. So they're already at an imbalance in terms of a starting point. But they can retaliate in kind, like those measures we just talked about there. They can make life awkward for US companies operating in China. They can make life awkward for US personnel operating in China in terms of visas and the like. And they can also diversify and punish the US in other ways, diversify and find new markets, which they have been doing when it comes to soybeans, for example, and other agricultural produce. But to be clear, the US economy is strong at the moment. They, of course, have the upper hand if it comes to tariff tennis, but there are ways where China can respond and retaliate.
Mm-hmm. Yeah, I didn't think that like PVH was going to be on my bingo list for like companies that China was going to go after. All right, Enda, thanks a lot. Enda Curran, Bloomberg senior economy reporter, joining us from D.C.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well. Head over to youtube.com/Bloomberg Podcast Live, and that's where you find it. Boy, we're right smack in the middle of earnings, but it seems to be overshadowed by just news flow. And last week it was DeepSeek and its impact on AI and calling that whole tech thing into question. This week it's tariffs. You kind of lose focus on some of the fundamentals. We want to get back to that a little bit here. RJ Gallo, Senior Portfolio Manager, Fixed Income at Federated Hermes, joins us. So RJ, again, we've had a lot of earnings the past couple of weeks, but a lot of noise as well. How do you and your teams kind of try to navigate through some of that noise and focus on some of the fundamentals?
Well, there's a lot of noise. The Trump administration, they must drink a lot of coffee. Very active, very active, and I think that's on purpose, both for political purposes and for substantive purposes. Many executive orders, a lot of changes, the sort of aggressive behavior of Doge, the novel use of tariffs invoked under an emergency statute that previously had not been used to justify tariffs. We expected this to be an eventful time. The big four policies, you have trade, immigration, deregulation, and fiscal policy or tax. They're all up in the air with the change in control in Washington. From a bond investor standpoint, the overall tone coming out of the Trump administration seems a little bit more inflationary, a little bit more deficit-ridden, and you would think yields would be heading higher. I think that got priced in October into November and as we started the year. So at this point, you just have to wait to see how those big four policy areas unfold. And it's hard to take a big bet on just rates. So we're trying to be patient. One thing that's nice, yields north of 4%. Are ahead of the inflation rate, and that's good for some padding to your total return as each day goes by.
So that's a great point in terms of it's too soon to tell, because are we going to look at treasuries as a safe haven or a risk asset now under President Trump?
That's another good question. I think that U.S. fixed income faces a number of challenges. There's more of it. There's more treasuries outstanding than ever before. Both in the dollar value of outstanding securities and in a relative sense, debt to GDP. That's the result of the long path of fiscal imbalances that we've had under both Republican and Democratic leadership. That, I think, is manifesting itself in just higher volatility. You have sort of the same universe of securities dealers making markets out there, but the market that they're playing in, the size of the market, has only gotten bigger. So that's a challenge, and that could eat into a little bit of the allure of treasuries as a safe haven bet. A safe haven bet shouldn't be extra volatile. It should be less volatile, right? That said, I think the credit quality of the United States is unimpeachable. I think that the depth of the market, massive liquidity, the strength of the U.S. economy in a U.S. exceptionalism sense, the underlying legal underpinnings, and the fact that we're one of the world's, actually the world's dominant power economically and militarily, that all supports Treasury still having a pretty hallowed place as a where safe
Right.
capital can reside.
So we were talking earlier today about the debt of the cruise lines, Alex, and it read headline crossing the Bloomberg terminal that Royal Caribbean has been raised to investment grade by S&P. So
there you go.
Good news there. Hey, RJ, I look across the fixed income space. I'm wondering do I just clip coupons here? Is that my game? Because that's not a bad place to be, whether it's in treasuries or even if I'm taking some credit risk. It really seems like I can get a meaningful carry here, and that might be good enough.
Yeah, well, the yield on the ag, the Bloomberg ag, is 487. That's higher than SOFR. So it's you're getting more yield, more carry from a diversified taxable investment grade bond portfolio than you are from money markets, and that wasn't true a year ago. So that's a welcome turn of events. It could motivate some investors who are in cash to move out the curve a little bit rather than watch rates continue to decline on cash if the Fed gets going on the easing side again. Number one. Number two, I think that at this point, as we wait to see how those big policy areas unfold, the economy's doing pretty well. Inflation, not 2%, but not apparently re-accelerating. And it feels like the bond market could be in for some choppy range trade, but all along you're clipping a higher level of income that exceeds money markets and inflation. So carry is in fact an attractive aspect right now of bond returns for investors.
All right, RJ, appreciate it. Thanks very much, RJ Gallo, Senior Portfolio Manager, Fixed Income at Federated Hermes. Really appreciate that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We're broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. We are also broadcasting to you live on YouTube, so definitely check us out on that. We've been talking a lot about different sectors and the effect of a Trump administration, whether tariffs or no tariffs. And one sector that's really in the crosshairs is energy. So joining us for more on that is Ernie Miller, CEO of Verde Clean Fuels. He's joining us in the studio in New York. Ernie, great to see you.
Thanks, Alex. Great to be here.
So we'll get to all the distinctions and tariffs and policies in a second, but just clean slate here. What does your company do? What is Verde Clean Fuels?
Verde Clean Fuels is a gasoline business, and so we operate in the Permian Basin and under a joint venture with Diamondback Energy out there, where we take their natural gas, which in West Texas has zero or even negative value, and turn that into a high value refined product, just commodity grade gasoline.
And the idea it's worth zero is because there's only pipeline to take oil out, for example, but when you produce oil, you produce natural gas and just kind of like hangs out and does nothing.
That's right. So when you produce oil, there are a lot of other products coming to the surface. Natural gas being the largest of those, and there's limited takeaway capacity. So that leaves an excess of gas in the basin that can't get to market.
So without getting too much into the chemistry of it, how do you do it?
Well, the chemistry was actually developed by Mobil in the 1970s, and so our process starts with synthesis gas, which is a mix of carbon monoxide and hydrogen. We take that to methanol, and then methanol downstream to gasoline. And so our product is just commodity grade refined gasoline made from natural gas.
And you're cool with takeaway capacity? Did they hit that in Landman yet, or no?
That was episode 3.
Oh, sweet. Okay, great.
Episode 3. All right. So are you doing that now? Are you refining it into the gas now?
Our first commercial scale project is well into engineering with Diamondback, and that first plant will be built in Midland County, Texas, just south of Midland, and it'll be commercial in 2027.
Cool.
Being a refiner is not easy. We saw that with Exxon and Chevron in their earnings. Now, clearly, they have a different input, right? They're inputting oil, which obviously their margins got squeezed if oil goes higher. But it's a tough biz. And then you put on, policy under a Trump administration, and then questions about tariffs. What's your biggest concern?
Well, you're right. Refining is a very tough business, and when you think about the tariffs that are being proposed right now, a 10% tariff on crude oil coming out of Canada will be a major hit to refiners, primarily in the Midwest. We import 4 million barrels of oil a day from Canada. It's about 60% of U.S. imports. And a tariff on those volumes will hit those Midwest refiners, who, by the way, their equipment is set up to to process that heavy sour Canadian crude. So it's, while they could go and buy U.S. produced shale crude, which is generally lighter and sweeter, but their refineries will not operate nearly as efficiently. So feedstock costs will go down, but they'll operate much less efficiently and probably net negative. So it's,
and there's nothing. I mean, did they pass that along to me and
ultimately
the drivers?
Ultimately, it's going to land in the consumers' laps. Yes.
Right. Interesting.
When you take a look at clean fuel, like this is cleaner, but it's not like e-gasoline or anything like that.
That's right. This is cleaner. Verde can produce fully renewable and even carbon negative gasoline. But the fact is that when you do that, the revenues are heavily dependent on carbon credits.
Right.
There's no term market for carbon credits. It's very much a spot kind of short-term market. So that does not lend itself well to project financing. When we use natural gas as a feedstock, when you can make the connection between a flare going away and us taking that natural gas would have otherwise been flared to produce gasoline, that gasoline is about 30% less carbon intensive than gasoline that comes from crude oil. So there is a pretty meaningful environmental win there. But that's the focus is commercial. This is taking zero value natural gas or negative value natural gas and turning it into something that has a lot of value.
You guys are based in Houston?
Yes.
Okay, so the center of this country's energy industry in Houston. What's the feeling there about the transition or the evolution, the transition to greener energy in general? Is the momentum slowing because of who's in the White House? Is there some inevitability that it's just going to go at its own pace? What's the feeling there?
I kind of think that most of the capacity to make this transition lives within the major E&P companies, major integrated oil companies, already.
Yep.
So those are the players that are going to make the largest contribution to an energy transition. And so I think that we're going to see a lot less in the way of mandates and a lot less of regulators picking winners and losers, and it'll be much more market driven, I think, as it should be. But ultimately the people that can contribute most to that are the legacy integrated energy companies.
How did the conversation and development with Diamondback come about?
Well, we were in the process of going public, of listing on NASDAQ, and Diamondback came to us with and said, we have been canvassing the market and have really kind of zeroed in on your process as one that can really help us with this natural gas problem that we have in the Permian Basin. And post Diamondback's merger with Endeavor, they went from a large oil company with a gas problem to a very large oil company with an even bigger gas problem. And so now they've got meaningful volumes of natural gas that that are not getting the value that it should.
Can I ask one more question?
Go.
I'm looking at Paul. Okay. If we wind up getting easier permitting, though, from the Trump administration, and we get the ability to get natural gas out of the Permian in an efficient way to then export it, does that mess up your model?
It really doesn't. There is such an overhang of natural gas, and Texas is already the most friendly environment, in the states for building pipeline capacity. In the last couple of years, there have been at least two 48-inch, enormous pipelines taking gas out of the basin. The Permian has the benefit of the Gulf Coast and the LNG terminals there in Corpus Christi. So there are places to go with that natural gas, but the volumes are just enormous. And so we are very comfortable that we have a very long runway in the Permian with Diamondback and others, where there's always going to be gas that can't get out of that basin.
Interesting. Fascinating story. I'm learning a lot here sitting next to Alix. Ernie Miller, thank you so much for joining us. Ernie Miller is the CEO of Verde Clean Fuels.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.